about the stock market, about cryptocurrencies, about everything that's happened in the market recently. You can comment below, or just if you're on Twitter, say good day, and I can respond to your questions live. I did one of these videos the other day on the stock market collapse, and it was really well received. Heaps of people said, hey, do another one. If you want a link to that other video about the market crash and what you can do to prepare your portfolio, be sure to go into the description. If you're on Twitter, just follow me and you'll see it in the feed down there. But I'm going to be talking about the stock market crash. Are we in a bear market? Are we, what do we do now, basically, now that we know that the market has entered this period of lots and lots of volatility? I'm going to do it. I'm going to try and eat this Tim Tam while we go. So I'm going to share my screen with you to begin with and just recap kind of what we know already. So what we know already is that here in Australia, at least, the S&P ASX 200, which is our primary index here, you can see that we've had extreme volatility over on the right-hand side of the chart here. You can see since 2013, there's been a lot of bumps. It's pretty normal for a stock market to have bumps up and down. And then you can see the COVID crash here. That was huge. It was just basically a cliff face. I remember at the time people saying this is the fastest, hardest crash they've ever experienced. And that was coming from people that had been investing for like 30, 40 years. And then over on the right-hand side, we can see what's happened. Importantly, here in Australia, when you look at this index, this does not include dividends. So if you include dividends year over year, the stock market fall isn't actually that much of a fall. So keep that in mind. If we look at cryptocurrencies, we can see Ethereum, which is the backbone cryptocurrency for a lot of the world's blockchain transactions. You can see here peaking at around about, 4,600. It's now down to $1,100 US. So massive falls in Ethereum. Likewise with Bitcoin, we've got exactly the same thing. Peaking, there we go, at around about 61,000. Now it's fallen down to 21,000. So I guess the old thing about cryptocurrencies being a inflation hedge, given that we've had a lot of inflation, may not necessarily ring true right now, because inflation is on the way up and Bitcoin and many cryptocurrencies on the way down. Of course, you could argue that's to do with other cryptocurrencies and stable coins failing, in which case, traders are just taking money off. I'm about to get to a short presentation, but basically what we're seeing here is, in my opinion, what we're seeing is a lot of investors taking their money out of risk-on assets or investments that are typically riskier. If you think about, different types of assets being on one end being very risky and on the other end being more safe, so cash in the bank, TDs or term deposits, so on and so forth at the other end, we're seeing as the global capital markets get tighter through interest rates rising, we're seeing more of that money kind of come back from those riskier assets and be pulled into other less risky assets, if you like. Here in Australia, we've got companies that were once, considered like the gold standard in terms of quality. So high quality companies like Xero right here, full disclosure, I own shares in this company. You can see this company too has fallen off a cliff despite reporting quite massive growth. If we look at Apple, it's very much the same with Apple, also falling off. I mean, this is not to as much of an extent. Here it's fallen from around about $180 down 130, still a substantial amount. You consider that this is a blue chip company, the biggest in the world, how big that fall has been. So if we jump across to, I guess the presentation that I prepared is trying to understand all this fear and greed in the market. What actually does it mean and how does it affect us? So a lot of investors have clung to this, I guess you could call it like a graph. It's a chart. This one here comes from CNN, and this one talks about basically where we are in the market cycle. And it uses different measures to think about, are investors feeling greedy? Are investors feeling fearful? Are investors neutral to what's going on in the market? This one here is for the stock market in the United States. And you can see here we are in extreme fear, and it has been in that I guess range for quite some time. The one I like to look at is the options volatility. So this is using derivatives, put options and call options, to assess where we might be in terms of how much fear is in the market. Puts are a right to sell, a call is a right to buy a share. So the more puts, the more fear. And we can see here that the market is also at extreme fear, having picked up recently. If we jump over to crypto, there are some indicators here too. And here is the fear fear and greed index from alternative.me. And this one shows extreme fear for Bitcoin traders and speculators as well. So this is right down the pointy end, as I said, on those risky assets. We can see here investors are equally scared. So what does this mean for investors? Well, the thing is, the way our brains are wired, a couple of thousand years of evolution hasn't been enough to stop us from feeling extreme fear when we're presented with the loss of something. So for us in a capitalistic society, what we often see is that we feel a lot of pain when we lose money. And this graph in front of you here comes from Kahneman and Tversky, which basically shows that we feel the pain of losing money nearly twice as much, or around about twice as much as we get from the pleasure of making money. So when it comes to investing, if you get a negative news headline, it's almost twice as impactful on you than it is if you have a positive news headline. For example, on our media site, on our investment news website here, I actually find for traffic, or I have found in the past, that when there's a down day, and let's say it's down, but the market's down by 1%, you could see that the traffic on that website is up twice as much as if it was as if the market was up 1%. And so we can see it. It's not perfect every day, but we can actually see this playing out in practice. People are actually really fearful a lot of the time, and that has a profound impact on the market in general. So I guess, how do we kind of understand where we are in a market cycle, and where are we with this fear and greed, and how can we understand this better? When it comes to behavioral biases, we do a very poor job of actually understanding ourselves. All we can really try and do is be aware of them. We can't completely eradicate these biases from our brains. So this is a chart. It comes from behaviorgap.com, and we've kind of made it our own. And you can see here that typically, like, the stock market or many different financial markets move in kind of ebbs and flows, like big waves here we can see. And here we can see that we've got someone who's very greedy and they're looking to buy, and someone who's very fearful and they're looking to sell. So if we go back to our charts and we're looking at where we might be in the fear and greed index, if we come back here, we can see that, hey, maybe we are actually in this very fearful mode. Not for sure how things are going to play out in the short run. We can see that if we repeat the behavior that we may have repeated in the past, where we use too much to buy something over here, so say we use like leverage to buy investments, market falls, we sell, we do that again, we're going to end up in the poorhouse because we just keep doing these things negatively. And you might remember from my last video how oftentimes the news that we get and that we receive, the information that we receive from social media or from the news, is often really uninformed, kind of hearsay, just rumor mill and gossip type crap that really doesn't lend itself to long-term investment decisions, where the stuff that you really need to know is actually extremely rare. So I would encourage you to go back and watch that video if you need to understand basically how we're influenced by different news headlines or different things over time. But if we come back here, basically what we have to try and recognize is when we feel greedy and when we feel fearful, and understand in ourselves how we can try to comprehend those. I find that in the time of crisis, by far the most important thing is actually having a plan. And I'll get to how that shakes out in just a second. But obviously, one of the most important things is actually understanding what you're invested in. A lot of investors have got to this situation and are very fearful right now because they don't actually understand what they're invested in. They don't understand things like valuation. They don't understand things like, well, what does this company actually do? What actually is going on here? Sorry, my dog is going a bit nuts here behind me. So for most investors, typically the first thing you want to do is actually understand what you're invested in. Whether that's a company or a stock, you actually want to just write down what it does. You want to understand some of the risks. Whether it's like an ETF, you want to know what it does. You want to understand, read through the document, see if there are some risks associated with that. Or if it's cryptocurrencies, I'm still surprised at how risky that asset class is, yet so many people don't actually understand what it does or how they propose to make money. We have these very shallow versions of an investment thesis that might be something like, oh, I think it's going to go to 2 US cents or something quite ridiculous, really. The important thing is that to understand why you own something and to be able to identify the risks with that. And so, I'll get to this. That's not necessarily a knock on cryptocurrency in general, by the way. It's just an observation. For example, I'll tell you a story that I heard over the weekend. Someone is around about 47 years old. He almost had his mortgage paid off, and this was when Bitcoin was on its way towards $100,000. So if we come back, Bitcoin was on its way towards $100,000. He reversed his mortgage, took out most of it that he could against his home, put it in Bitcoin, and has watched it fall by about 60% since he made his investment. So that's now a huge mistake on his behalf, obviously, unless he comes back and somehow, it somehow reverses those gains, or somehow he can make money from that. And when I hear things like that, it's very unfortunate. But if he'd only understood some of the risks before he invested and he wrote them down, he may have gone in with a more diversified position or not used leverage. So how do we kind of bring balance to our investment portfolios? This is the same chart I brought up in last week's video. Here, what you can see is that we have a core and satellite approach. In the middle, we have our diversified portfolio. I'll zoom in a bit. We have our diversified portfolio, and around the outside, we have our satellites, which are our smaller, more speculative things. So if I was designing a portfolio from scratch today, I'd maybe have a bunch of ETFs or index funds in here, maybe some low-cost, managed funds or whatever. And then around the outside, we have more speculative things. That's where your crypto assets or your small cap shares or whatever might. The important thing is this green bit here. The way you construct this portfolio is that it's actually tied to your long-term goals. So it shouldn't be to your short-term goals. It should be to your long-term goals. And then around the outside, you can afford to take shorter-term bets, if you like, or risk. And so when we are in a situation like now, we find that this part of the portfolio holds up extremely well because it's diversified, it's balanced, it has a mixture of different assets. But if we zoom in on individual shares, I know a lot of my followers would want me to talk about individual companies like Xero or Apple or Facebook, Meta, whatever. If we zoom in on individual companies, the way I get comfort in times like this, no matter how I'm investing, actually by just looking, is actually understanding the valuation of my company. So this is on a case-by-case basis if you're an active investor. If you're in an index fund, it's pretty easy. You've diversified. You've got low costs. You can just keep going into it. G'day, Al. Greetings to you. So you can actually study the companies very closely and you can determine intrinsic value. I like to think of the valuation of a company as kind of like the handlebars for in investment. So you can kind of grab the handlebars and you can steer where you're going. Whereas when you don't understand valuation, you don't actually have that, I guess, thorough, in-depth knowledge of the company or what you're trying to invest in, you can actually be led astray because you can take your signals from the price action. So say, for example, if we've got Xero here and we've looked at Xero over many years, we can say, okay, it's going up in value or it's going up in price, but what's it actually worth? Maybe it was at, I don't know, $20, you thought it was worth $50. But at $50, you thought it was worth $60. It goes up to $85, and you think, okay, now it's overvalued. If you have that type of understanding, you're less likely to succumb to the ebbs and flows of the stock market, and you're actually more likely to be in control when certain things happen. For example, let's go back to our chart. You will know that if a stock falls below your valuation, that it could be a time to buy it, or if it just goes above it, then you maybe know it's overvalued. But the only way you truly can make that assessment, and you can know if, okay, yes, the stock market's down, but I think it's decent value. The only way you can truly know that is if you put in the work and you understand how valuations shake out, I guess. And so this is a bit of a plug for our Value Investor program with Equity Mates. If you're interested in joining the course, jump on board. You can get $100 off before the end of the financial year. Use the coupon code Value Investor. But we've also got free courses for anyone that's interested over on Rask Education. Jump in. We've just launched these free courses. These are more focused on like money hygiene, sorting out your taxes, getting everything in place for the term. So it's like building a diversified portfolio and all that sort of stuff. You can head to Rask Education. But it's great. I think times like now, when the market is extremely volatile, this is the time when we want to go back to some of those long-term studies. We had this discussion last week where we talked about, it doesn't really matter even if you have perfect timing or you don't. oftentimes one of the best things you can do is just invest right away. And we can see that here in this chart. Last week, I also recapped on how people succumb to recency bias and so on and so forth. But ultimately, in times like this, in times when the market is so unknown and there's volatility everywhere, it comes back to simple principles about long-term wealth creation. It comes back to focusing on what you can control and remembering that we're our own worst enemy. So if you are dollar cost averaging into an S&P 500 ETF, or you've got an ASX 200 ETF like STW, or if you're trying to be more conservative and you've got more bonds or hybrids or something like that in your portfolio, maybe now is the time to think, okay, is my portfolio still in balance? And what does my investment plan say? An investment plan doesn't have to be something super complicated. It could be sometimes it's just on an A4 sheet of paper, and it's basically a set of rules that you can follow in the future. You can say, this is what I'm going to invest in. This is why, and this is my long-term goal. Here's how I'm going to do it. If you want me to do any more videos just like this one, or if you want me to go deep into individual stocks or companies, managed funds, whatever, or markets, just let me know and I'll jump on at the end of a business day and I'll say g'day. I haven't actually finished that Tim Tam, which I promised I'd finish. Tim Tams are a delicacy here in Australia, so I should really get into it. But I think the important message from today's short video is just to stay calm. Remember that we often are our own worst enemies. The news headlines are kind of against us. There is a lot of fear, a lot of uncertainty in the market with interest rates, inflation, so many different things. But it comes back to just maintaining your calm, what you can control and what you can't, and knowing what you're invested in for the long term. I think if you do that, I think you give yourself the best possible opportunity to maximize your wealth creation in this market environment. Al, you've just come through with a question right as I was about to bite my Tim Tam and sign off. You said, hopefully this doesn't come in too far out of left field, but does anybody do a Cape type chart for the ASX? Actually, it's interesting you say that, Al. There is, if I've got it here, no. There is a chart that look at, you can head to Market Index. That's marketindex.com.au. They do not a Cape, but they do something very similar for the All Ordinaries. I'll see if I can get it up. Market Index, I think it's ASX P ratio, something like this. We'll have a quick look. Here we go. This is the one that you want. It's marketindex.com.au/statistics. And it shows you don't need to necessarily use Cape because Cape is just cyclically just PE ratio. You can use anything as a ratio, right? So here we've got dividend yield. We've got the PE ratio here. You can see it's actually not that far above average. So, yeah, I will enjoy this Tim Tam. But you can see here, I hope it's not crunching too loud on the microphone. You can see the earnings yield and everything for the Aussie market. So this is marketindex.com.au/statistics. And you can see here, I don't take a lot from the Schiller PE ratios and that type of thing. But if you do, cool. This one here, I think, you can just look at COVID as an opportunity to think, well, does this actually inform my investments that much? I mean, if you saw the P ratio during COVID, you would think, Jesus, this is an absolute sell, so far above average. But that comes back down to earth. So I hope that helps you, Al. Thanks for jumping on and asking a question. But that's it for me for tonight. My name's Owen Rask. You can find me on Instagram, or don't follow my fake Instagram account. Someone's tried to copy me. You can find me on Twitter. Say g'day, and I'll answer some of your investing questions whenever I get a chance. Thanks for tonight. Stay calm, stay cool, and remember, onwards and upwards. The stock market is still the place that you go, not for Tim Tams. It's the place that you go for long-term wealth creation. Tony, here we go. One more question from Tony. Tony said, "Hi, Owen. What is your view? What is your view on targeting stocks that recover the fastest during the crash based on previous recessions?" Yeah, that's interesting, Tony. I haven't actually formed a view around that. So what's my view on companies that recover? I think I try and do it on a case-by-case basis, Tony. I try and look at companies individually if I'm doing it that way. I mean, if it's the market, it's a bit different, like if you're investing in a diversified ETF. But if it's, for example, like a good example might be a company like Apple, right? Like during the global financial crisis, let's see if we've got the chart for it here. I'll see if I can go right back. I don't know the answer to this. I'm doing this on the fly. We can't really see it here. It looks like it fell from like $5 down to around 2. So that's a pretty big fall, right? But if we looked at the company fundamentally, Tony, we'd probably find out that Apple still grew during that period, or at least it was pretty quick to bounce back. So I try and find companies on a case-by-case basis where they can still grow. Like structurally, they can keep growing. We saw that during COVID. The saying at the time was, never waste a good crisis. At least that's what some of the CEOs were saying at the time. So I actually just put out a tweet. I'll just quickly jump on my Twitter. This one right here. So this is an interview I did with a guy called Storm McGrath recently. He's the CEO of Kip McGrath. That's this one down here. And it's one of the best performing companies over the past 10 years on the Australian stock market. And in that's a fantastic discussion. But in that, Tony, you get a sense of like how he thinks for the long term and how they've been through adversity time and time again, and yet they've come out ahead. Now, that's not always going to be the case, and I'm not making, there are no recommendations here tonight. This is purely general financial information, but I think I'm looking for companies on a case-by-case basis that have great management, that have long-term runways, and I can buy at a reasonable valuation. So I hope that helps, mate. Looks like I need to get back on my Twitter. So thanks, guys. Have a wonderful night, and remember, onwards and upwards. The world isn't ending anytime soon, so where do you go to invest in value creation? To the stock market. So thank you, guys. Have a wonderful night.